In this last part of our overview about financial statement fraud, keep in mind the following infos. Definition of financial statement fraud. The deliberate misrepresentation of an organization's financial condition through manipulation or omission of financial data. Motivations. Achieving earnings targets. Avoiding negative market perceptions. Manipulating stock prices for personal gain. Fraud triangle framework. Pressure, financial or performance pressures. Opportunity, weak internal controls or oversight. Rationalization, justifying fraudulent behavior. Types of financial statement fraud schemes. Fictitious revenues. Recording sales that did not occur. Example, creating fake customers or inflating invoices. Timing differences. Improper revenue recognition or expense deferral. Example, recognizing revenue before goods are shipped. Improper asset valuations. Overstating inventory or accounts receivable. Example, manipulating physical inventory counts. Concealed liabilities and expenses. Omitting liabilities or deferring expense recognition. Example, Bali Total Fitness deferred advertising costs. Improper disclosures. Misleading or omitting critical information in financial statements. Red flags for financial statement fraud. Rapid growth or unusual profitability compared to peers. Negative cash flows despite reported earnings growth. Significant transactions near reporting periods. Overstated inventory or accounts receivable. Unusual or complex.
Unmasking financial statement fraud, a case study of deception. In today's complex business environment, financial integrity is not just a legal obligation, it's a cornerstone of trust. This video explores the story of Bright Future Tech, a fictionalized case inspired by real-life financial statement frauds. Through this case, we'll uncover how deception unfolds, highlighting lessons and strategies to help corporate leaders safeguard against similar schemes. Visuals: a bustling corporate office and stock market ticker contrast with upbeat music. What happens when a company bends the truth to look more successful than it really is? Let's dive into Bright Future Tech and the fraud that deceived investors and shook the corporate world. Text on screen: Financial statement fraud, a case study. Bright Future Tech, a promising startup, succumbed to the pressure of meeting investor expectations. Executives manipulated financial statements, inflating revenues through fictitious sales and delaying expenses to exaggerate profitability. This deliberate misconduct highlights two common techniques: fictitious revenues, fake sales to non-existent clients; expense manipulation, not recognizing expenses on time. Interactive element: what red flags would you look for in such reports? Executives in a boardroom discuss financial targets, alongside falsified documents and manipulated spreadsheets. What drives such fraud? Motivations include meeting aggressive earnings targets, gaining investor trust and funding. However, red flags are often evident. Unusual profitability that defies peer comparison. Cash flow inconsistencies despite strong profits. A split screen shows the CEO celebrating funding success, while an auditor scrutinizes discrepancies. Fraud has far-reaching